Good day, ladies and gentlemen, and this is Barry Norman, and welcome to our Sunday webinar, The Trend is Your Friend. Today's class is brought to you by ETX Capital, and for those of you that are joining us for the first time, ETX is a regulated provider, therefore I'm required to give you a risk warning. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. All information that's provided in this webinar is for educational purposes only. ETS Capital and the presenter are not financial or investment advisors and do not recommend any securities or instruments of any kind. Any securities or instruments that are mentioned throughout are for educational purposes only. Now, ETX, for those of you who are joining us through the internet today and don't know much about us, ETX is a fast-growing financial services company based in London, and we are physically in London. You can come by our offices and say hello, or most time when you're watching BBC, CNN, Bloomberg, you'll see them conducting live interviews with our account managers and our technicians in our office, so you can see us in the background. We are authorized and regulated by the FCA, the Financial Conduct Authority. We have a very broad global client base, and we are a member firm of the London Stock Exchange. We offer many different types of trading methods. Whether if you're in London, you can trade spread betting, or around the rest of the world, CFD trading. You can trade binary options with us, Forex, commodities, and stocks. You can use our MetaTrade platform, our MetaTrade 4 platform, or you can also use our web trader or our binary options platform. It's all up to you. No matter what you want to trade, ETX is there to help you along the way. Now, today's class is called The Trend is Your Friend. And regardless of how and what you want to trade, the trend is the most important line that you can put on your chart. It is not a matter, it is part of what's called technical analysis, but it's not a secret tool. It's part of the basic information or the roadmap that you need to build to understand an asset's movement. Now, when you start reading your charts or using charts, the first line that you should be drawing on your chart at all times, and the first line you should be aware of, is the trend line. Now, if you're not exactly sure how to build a trend or how to read a chart, or as I said, if you're not exactly sure how to use your chart so that you can build a trend, or you don't know the differences in between charts, we offer a lot of classes. You need to come to our class called Charting Basics. And there we'll teach you how to start building your roadmap for success. Now, learning how to read a Forex chart is considered to be somewhat of a science. They look complicated at first glance. A Forex chart can look drastically different depending on what options you use, what service you're using, what the background is, what your settings are. Charts usually have settings to display styles of price and time frames that you want to view. Time frames can be anywhere from 1 second to 10 years, depending on the charting system. Price can usually be displayed as a candlestick, a line, or a bar. There are 3 basic charts, and today we are not going to be learning all the difference about charts. Today we're going to, in a second, assume you know how to use charts properly. Now, a chart is a graphical depiction of price movement over a period of time. And there are 3 generally accepted styles of charting, or types of charts. We have a line chart, which gives you very little bits of information. It just kind of shows you the general movement of an asset. Then we have a bar chart, which is my favorite type of chart. And then we have candlestick charts, which are very, very popular today. Now, next month, we have a 2-week course in how to use Japanese candlestick charts. And unfortunately, candlestick charts are a great way to trade, except too many traders think that they know and understand these reds and the greens, and they don't spend the time learning what the candles mean. And the reds and greens are really unimportant to a candlestick trader. It's the patterns that are established by the bodies and the wicks of the candles. So make sure you come to that class so you can properly learn how to use candlesticks And you'll also learn the 16 primary different patterns found in candlesticks. Now, for personally though, I use a bar chart, especially for drawing my trend lines. Because today with the new Java charts and HTML charts, you can use whatever you want, because all you do is click a button. So I like to work on a bar chart because it's clean and neat and allows me to see price movement easier. And this helps me to draw a more accurate trend line. Okay. Then you can change back over to candlesticks. I use both, but I always start out with my bar chart. And each line on a bar chart gives you 4 pieces of information. It gives you the open, the high, the low, and the close for that time frame. Now, why is this important? Well, it's important for a lot of reasons to help trading. But when we're drawing a trend line, we need to find points in common and swing lows and swing highs, which are the bottoms and the tops. It's easier to find these using a bar chart and then flip it over to a candlestick chart once you have it, because it doesn't change the trend line. Now, trend lines are a useful tool for visually highlighting a trend and the potential of being part of a trading strategy. There is a lot of mis and inaccurate information about trend lines though. Learning how to use a trend line effectively, if you're going to use them, is crucial so you don't fall into a lot of the common traps. Trend lines are a technical analysis tool used to define and project price trends in major markets such as stocks, Forex, and futures. Trend lines have the potential to alert us when a pullback is over or a trend is resuming, or when a trend is accelerating or reversing. Now, a trend is whether you're trading in Forex or you're in fashion or you're in women's shoes or you're in cars. A trend has got the same definition. It is something about what is popular or what is current at the moment, a direction in which the market is moving. Now, sometimes with women's dresses, the hemlines are moving up, and that's the trend. Sometimes women are moving to pants, and that is them. Sometimes in women's shoes, high heels and higher heels are becoming more popular, so that is the trend. In cars, sometimes we're trending to SUVs, or we're trending to four-wheel drives, or we're seeing more and more sales of small gas-efficient cars, and that is the market trend. Same thing in the financial markets. Price, though, is the ultimate indicator, though, in the financial markets. Therefore, price action must always be considered when using trend lines. Now, trend lines are drawn on charts to help predict the general direction of price. They also help you see reversals. On the chart we're going to look at in a second, the green line is the trend line. Trend lines also help to determine good entry and exit points and help you decide where to put your stop losses. So wow, they could be called magic lines, right? Well, not really. They are quite good, but like any form of analysis, if used alone, they won't make you many pips. However, they make a great addition to your trading arsenal. Now, the main problem with trend lines is placing them on your chart. It can be a little intimidating to start with, but it's quite easy to get the hang of it. Okay. Now, unfortunately, now here's the green trend line. Unfortunately, too many traders, whether you're a novice, a newbie, an experienced trader, or been around for a while, or coming from a different market, everybody wants to come up with their own system, their own strategy, their own rules. They want to outsmart everybody else to find the better trade. Well, in order to do that, you have to have some ground rules, and you also have to know what everybody else is looking at. Because you can't customize your trading decisions if you don't know what everybody else is going to act or react to. And a trend line is one of the features that's not customizable. A trend line should be drawn exactly the same as a million other traders around the world. You don't want to have your own unique trend line. You want to know the important trend lines and the valid trend lines that are ongoing in the market right now that all the other traders are looking at. Because when you can predict price action and price movement, you can then make important decisions. But when your trend line is different than everybody else, you're expecting a price action or reaction at a certain level. And guess what? You don't get it because everybody else is looking at something different. So by knowing what prices are crucial to the market and where they should see some type of reaction or action, doesn't mean the price won't break through, but we will expect some type of reaction based on the trend line. Or if there's a breakthrough or a breakout, or the trend line is reversed or a retraction. All of these things will be important in you predicting and making the right trading move. If you don't know what the bases are, you can't use your other strategies. So to draw a trend line properly, we have some rules that we stick to. And they're not complicated rules. Anybody can learn these and master these in no time flat. It's getting yourself to follow the rules, because there's too many ways that you can easily deviate. Now, there are two main types of trends. We have bullish trend lines and bearish trend lines. A bullish trend line has a positive slope. In other words, an uptrend. A bearish trend line has just the opposite. It's moving downward. Now, a bullish trend line has a positive slope and is formed by connecting two, and I'm going to say this over and over through this class, two or more low points. The second swing low must be higher than the first swing low. So in other words, to draw a trend line in an uptrend, when price is moving up, you have to locate two swing lows. Okay. Now, if you don't know what a swing low is, a swing low is the lowest price that that asset traded at, not the close, not the open, not the in-between point. It is the price where in an uptrend, it is the lowest price that that price peaked to. So in other words, you're using the peaks and the valleys created by price movement. Okay. You start your trend when the last trend has reversed or price starts moving, and you find the swing low. You then lay a ruler or a straight edge, or if you're using a computerized chart, pull it forward to connect a second swing low. And at no point could price ever have broken through that line. So in other words, just trying to get my marker on here for you. In other words, we start finding the swing low. The swing low is the lowest point that the price had traded at. We then put our straight edge on here and start pushing it into the future. Okay. Now, originally, we might have started drawing it this way. Okay. But the minute that that price broke below that line, that trend line is no longer valid. So you have to go back and find a new trend line. Okay. And for the current price movement, this is the trend line. Okay, so we've connected a swing low here, a swing low here, and a swing low here. Okay, and we've drawn our line out into the future. Now, too many traders would like to draw their line, and I'm sorry, I can't draw very straight lines on here, but they would like to have drawn their line this way. Traders want to always seem to try to connect their trend lines to where price currently is. Now, the thing is that that wouldn't have been a valid trend line because this dip down here would have had broken through there. Now, a trend line can be drawn using two swing lows, but it is not a valid trend or an active trend line until it is touched a third time. And this is critically important. You must have 3 points in common on a trend line for that trend line to be considered an active, valid trend line. So in other words, this trend line right here doesn't have a third valid trend line, so a valid touch. So it is not a valid trend line. We're waiting for price to come down and react to that trend line to validate it. If at time price breaks through that trend line is over. There's no other interpretation. There's no squeegee. There's no, let's let that slide. If that trend line is broken, the trend is over. It is no longer valid. Or you can no longer wait for it to be validated. Okay. A bearish trend line in a downtrend is done exactly the opposite. It is drawn over the top of price movements using what's called the swing high. Now, once a trend line is placed and it has a third bounce, it becomes active. Now the price should find support and resistance at the price line. It should have trouble breaking that line. If the price does not break the line, it usually means the trend is over. So placing lines is pretty easy. All you need to do is identify 2 swing lows and 2 swing highs and draw a line joining them together. There you have it. Now your chart has a trend line. But wait 1 minute, newbie. Even though you can place a trend line based on 2 swing highs or 2 swing lows, the trend line remains unconfirmed until it is hit a third time. So what you see here is on my little chart up here to the right, you can see the uptrend. Now there's 3 types of trends. There's an uptrend, a downtrend, and a sideways trend. Okay. And the way a trend line should go, okay, doesn't always happen, as you should see price move and thrust upward. It should ease back down and then thrust upward again, ease back down and thrust upward again. And at no time should, during the easement, ease below where the prior low was from the prior thrust. And this is how you get a trend line that has no price broken through there. Okay, when price is moving properly and you have a actual trend line, this is exactly what you get, or the opposite in a downtrend, or the same in a sideways moving trend. Okay. It is the peaks and valleys formed by price movement. So imagine if you just reason it out, you have the bulls in an uptrend, you have the bulls are dominating the market. The bulls are buying, buying, buying. At some point, they need to ease back. Either they're all bought out for a minute, or they want to ease, they're tired, and they want to ease back, but they're not going to ease back that they're changing their minds. They just want to gather a little bit of time. They want to gather a little bit more energy. Then they come back and push the price back up, and then they ease down. They push the price back up, and they ease down. This is a good trend. Now we have what we call weak trends, which are price moving on an up movement, but they don't fit any rules, and they're all rattled all over the place. And it's very hard during a weak trend, whether it's an uptrend or a downtrend, to really successfully trade. A weak trend can be very misleading because it can reverse very easily, very quickly. So trend lines can be placed on any time frame, but the more effective on longer time frames. Also, the longer a trend is active, the stronger it gets. So the 2 charts you're looking at are actually continuations of the earlier charts. They're the same exact asset moving in the same exact manner. So we had originally drawn the trend line through this point, and this is where we sat in that trend line waiting for that third point of validation. Price continued to move up, then it eased back down and hit that trend line and validated that trend line, and price moved forward. And you can see price moved in a push, ease, pushed, ease, pushed. Now, moving forward or continuing it on forward, what happened was price came down to that trend line and broke that trend line, went into a reversal and reversed and went into a downtrend. Now, We did not know, or we could not predict it was going to reverse and go into a downtrend, but we could expect a price action or market reaction at this point. When we didn't get the bounce off the trend line and the price moved down, we then were ready to make some decisions because we knew that there should be some action or market action or reaction to that trend line. We saw what it was. So now we're ready to then add on our other steps or our other formulas. Or if we're waiting to make a trade and we're using other indicators and we're waiting for something to tell us, okay, now it's time to make that trade, this would have given it. So we validated that trend line, we verified that trend line, and then we broke that trend line. And this is how you would interpret price movement. Now, as I was mentioning earlier, traders like to draw trend lines on that look nice, that fit price, that are where price is. So without using the following rules, a newbie trader who says, I can always draw a trend line, would have drawn this and would have ignored this entire price movement here, where the trend line was broken, which gives them an incorrect trend line. The correct trend line would have been drawn on the chart here. It would not have had a third validation, so it would not have been an active trend line. But it was never broken, so we could then predict price more accurately because all the traders around the world are trading on this trend line, not the trader's own personalized trend line. So we can then judge the reaction. Just like in the previous chart, here, when price was moving up, it came back and broke that trend line. We're now seeing what everybody else is seeing, and they're reacting to this price movement. Now, I'm not telling you what you should do at that. What I'm telling you is everybody around the world is now making their decision. You're making a decision at a valid price point as opposed to making a decision at a non-valid price point. So let's go over the basic rules or the tips. Okay, we want to draw a line connecting either two or more swing lows or two or more swing highs. For those familiar with the term swing lows and swing highs, we simply mean the peaks and the valleys created by zigzag prices. Once we connect peaks with other peaks or valleys with other valleys, we want to see that the line has not been broken by any candle or any bar between those 2 points. You've probably noticed that I have referenced two or more highs or lows make an uptrend or downtrend. The reason I mention or more is because trend lines can continue to be relevant far out into the future and can be bounced off of several times, especially when you're looking at longer term trends, because we have short-term trends, intermediate-term trends, and longer-term trends. A trend line has to be valid in the time frame in which you are trading. So a long-term trend, which you can have a long-term trend that goes back 10 years, 20 years. You can be looking at gold over since 1986, okay, and see that it's in a long-term uptrend. That's the long-term uptrend. But if you're trading gold in a very short term, or in a day trader or a swing trader, that's not going to help you much. But you can have short-term trends with inside intermediate-term trends with inside longer-term trends. And you can build these together because together they tell you a story. Now, as a general rule of thumb, the more times a trend line has been hit and respected with a bounce, the more important the market believes that it is. So imagine you're looking at gold and you've got this long-term trend line going back to 1986 drawn forward, and it's still an active, valid trend line. And you've got a short-term trend, and you're trying to decide where to enter or exit the market. And you see gold drifting down, and it's coming down to this long-term trend that's been holding up since 1986. Would you consider selling at that point? Would you consider exiting the market at that point? Okay. So that trend line is broken. So when you hear people talking about gold at $1,100, that's not a short-term trend. That's based on a long-term trend, and that's a very important level. Okay. Now, the first reason this is true is that you can draw a line connecting any 2 points on a chart. Just because there were 2 distinct highs in the last 50 bars and you drew a line between them doesn't mean they actually make a valid trend line. What you would have is a potential trend line. Each time you see price bounce off that same line, the more likely it is that others are watching it too and playing the same game you are. This could help you get several good entries in a row. And remember, trend lines won't last forever. So you want to make sure you set your proper stop losses to get quickly out of the market if the support and resistance trend line eventually fails. Now, this is the first time I'm mentioning support and resistance because this is what the trend line tells you. It's the first part in building support and resistance on your charts. But before we go on a little bit farther with this, let's go over to some live charts and actually go through the steps of drawing an actual trend line. So let me pop some charts up on your screen. They'll be in front of your screen in a minute. Okay, so we're looking at the Euro US dollar. Nothing complicated here. We're looking at the Euro US dollar on a 1-hour chart, and we're using a bar chart. Now we can see that the euro is moving up in an uptrend. Okay. That's not a trend line. We're just visually looking at it at the moment. Okay. Now, because we're looking at a 1-hour chart, we can see that this price movement started back here on the 15th, sometime midday in the 15th, and price has been steadily moving up. Now, we're not talking about the euro has gained momentum because because these economic reports came in, or the dollar is weakened against the euro because Donald Trump hasn't been able to do much of anything that he promised to deliver. We don't need to talk about this. We're not talking about fundamental analysis now. We're not talking about market news right now. We're not even really talking much of technical analysis, but anything we do on our charts falls in the area of technical analysis. So now we want to draw the correct current trend line for the type of trading we're doing. Now, if you're a day trader, you might want to look at this on a half-hour chart. But the thing is, once you've drawn it on a chart, you can change your time frames. And you can have, like I said, many trend lines on your chart. You could come back here and take this as the beginning of your uptrend right here and take this forward. Now, if we say that, we can have a longer-term uptrend. That's a very nice uptrend. But what we had is an uptrend and a downtrend within that longer-term uptrend. Then we bounce back and we're in the middle of that uptrend. So this could be a very nice longer-term uptrend. So we're going to go to the swing low and we're going to bring it up to see where we can drop it on a chart where we have another point in common and also have not had any violations of that line. So what we're going to do is we're going to come up here on the charts and go to the little thing that says trend line. We're going to click on it and we're going to draw a trend line. So we're going to come down here to the swing low and we're going to pull that line forward and bring it up as high as we can without having any violations. So now we've drawn a very nice, actually it's a very nice accurate trend line that has actually 2 valid points in that, right now. So we have we have our start right here, so that gives us 1 valid point, and we have our swing low point here, and now we have an unverified or not active trend line moving forward, but it is really a very nice trend line. And now what a trend line does, it begins your support and resistance. Any area above the trend line, if it's an uptrend, and the reason we draw it underneath is because it is a support line. So it is supporting the prices above here. It's giving the basics, and this is the first part of support to the price. When price comes down to it, this trend line should support that price movement. Now, when price falls and breaks through it, that trend line becomes its resistance line. But in most cases, we will expect that trend line to support the price. And we have a very nice valid trend line that's not been activated yet because we don't have a third point in common on this chart. Now, we're not going to see it today because the markets are closed. But this is where we would start. Now, you could, if you wanted to, have a shorter term trend line from here starting with this movement because, see, you had a downtrend. You could actually even start it there. You had a downtrend which ended, and then price moved into this uptrend here. So you could say that this is a long-term trend with a short-term downtrend and an intermediary uptrend. Okay. You would have to define it as a separate trend, but you could have that trend line on there, which would help give you more precision on pricing. So we could then draw this secondary trend line on here. Let's change this to, let's make this a blue. And now we have a secondary trend line. Okay. It also has not been validated as of yet. Actually, it probably has if I were to draw it on a little bit more accurately. We actually have 3 points that touch here, here, and here. So we actually have a very good valid trend line. So now we've actually built zones. We have 2 support zones on this chart, one with a longer term trend, one with an intermediate term trend. And one is active. The blue line is an active valid trend line moving out in the future, so it is more important. But we can simply change these because when you change the time frame on your charts, and the way I also validate my trend lines is to look at them in different, or they've been validated by being touched 3 times. I want to see how significant they are. So by changing time frames and seeing that those trend lines still hold true in other time frames, help me understand a little bit more about how valid they are at present. So I'm not so sure about the ones we just drew on here, because you have to then make the decisions based in your time frame. But when we change it over to a 2-hour chart, those trend lines are very, very nice. So let's stay with those. Those are very happy trend lines. Okay. So what we would then predict is that we should get some action on price at this level, at the 107.80 if it comes down to here in its trend line, or as it's moving farther out into the future. So we have multiple trend lines. Now, if we were to change this chart back farther, because right now we've looked at a 30-minute chart, a 1-hour chart, and a 2-hour chart, but we've only covered these charts have only covered price movement over the last couple of days, the last week, the last 10 days. Well, wouldn't you want to know where the euro is standing? Because right now we look at the chart, we see the euro in a strong uptrend. But is that true? Where does the euro stand overall or in a longer term? Because technically, we're in a shorter term or intermediate term uptrend, but we're really in the middle of a very long-term downtrend. And by understanding that, you know a little bit more about what's going on. I mean, it's like seeing somebody who's lost a great deal of weight, and you know they've lost a lot of weight. They were huge. You know, they were very overweight, and they've slimmed down. They're still slightly heavy, but they've done really well. But if you don't realize that that person's lost a huge amount of weight to get down to the point where they are, then you just think that person's overweight. But if you understood they lost a lot of weight, or that person then got thinner than that and then put on a little bit more weight, so somebody's saying, oh, that person's added a lot of weight. You know, so understanding the perspective of where you are is very important. So we're going to drop this back to a 1-day chart. Okay. Now, you see our trend lines, they remain, and that's the nice thing about the new charts. They all remain, and they stay very active. I mean, they're very, very nice trend lines in a 1-hour chart even. They're supported, they're not violated, they're held up. But now we can start to see all the way back into March of last year, and we can actually see that the euro is recovering from a longer-term downtrend. If we go back to a little bit longer chart, look at a 1 week, Then what do we see? Well, we see the euro's at the bottom of a multiple year downtrend, and it's still at the very bottom in a sideways action since April of 2016. Yeah, 2015. And we can see a very tight trading range and a huge weakness to this euro. So now you're starting to actually understand a little bit more about the personality of this asset and the perspective in which you're seeing. But again, the nice thing about the new modern charts is they save all of these right on there. So when you look at the trend lines we just drew, and those trend lines hold true, and look at them, they're very, very nice trend lines. It's very rare in a class that we actually are able to draw a trend line that's actually validated. It's very rare that you actually get a trend line that's got 3 points in common. Usually you're sitting back and drawing one and waiting for the third point to come in common. So now we have the basics of drawing a trend line. So let's go back to the PowerPoint and let's talk a little bit more. Now that you can put it on your chart, let's talk a little bit more about what you want to do with these things when you start putting them on your charts. So let me pop the PowerPoint back up here for you. Okay, now the third tip, and this becomes very important, and this is why we call the trend is your friend. You should buy bullish trend lines and sell into bearish trend lines. The steadfast rule also applies to trading trend lines. For experienced traders, it basically means we should only look to buy at bullish support lines and sell at bearish support lines. You don't want to go against the trend line. When price is moving up, you want to look for opportunities to buy, not be a contrarian to sell through that trend line. Okay, or when prices bounce off that trend line and peaked up to come back down the trend line, we can't predict where these are, but people are always looking to trade against the trend line. Okay, when you do this, this is not saying that you're going to be wrong. Okay, if a price bounces on the trend line, touches the trend line, bounces off of it, okay, you could have bought up in that. You would have bought because that gave you a significant entry point. Okay. If you decide I want to sell into that trend line, it's now hit the top level and we want to sell down to that trend line, you can do that and make some pips. Ultimately, you will be more successful statistically trading with the trend line, and you'll make better, larger trades. And this is not my belief. This is a market adage for many, many, many years. Smart traders only trade with the trends. You buy into bullish trends, you sell into bearish trends. Not because you're going to be right or wrong. Statistically, you will make more profit and more pips doing this than the other way around. And we're all about making the most pips we can make. So trading only in the direction of trend will let you exploit potential trend line bounces as efficiently as possible. And while they won't give us winning trades, the trades that are winners should give us more pips than if we attempted to place a trade against a trend. Coming full circle, trend lines are a very simple tool to use. You are connecting dots on a chart. But hopefully the 3 tips that I gave you will make trend lines take trend lines to the next level. Make sure that lines you draw are connecting 2 or more highs or 2 or more lows, but have not been broken by price between those trends. Remember to look for a third bounce to validate a trend line. Also make sure you're taking advantage of trading with the trend by looking for buys in bullish markets and sells in bearish markets. Now, whether you use a trend line or indicators, price action ultimately determines how much money we make. Learning about price action and how trends move is never a bad idea. Once we understand the basic concept of how price moves, then trend lines become a more effective tool in helping us analyze price action. Price constantly moves up and down, even within a trend. While most traders know this, they have a hard time applying that knowledge in real time. Traders often wait too long before either buying near a top of a wave and panicking as the pullback begins, and selling at the exact time they should be considered buying. Trend lines can help us in these regards. And this is very, very important because a trend line will help us see retracements, reversals, continuations. One of the best reasons to learn how to read a chart properly is so that you can apply technical analysis. Not every trader believes in using technical analysis, but it can be useful even if it's not your primary trading method. Now, trend lines give you three pieces of information. They show you the direction and the strength of the current price movement, which is something that people overlook. The steepness of that trend helps tell you how strong that trend is. And that's very, very important. And it also gives you support and resistance for the trend. Future support and resistance of current price movements are very valuable pieces of information. And there are several trend line trading systems that are based on this support and resistance alone. Now, trend lines are one of the most basic concepts, but what they help you do is get pieces of information to try to put this puzzle together. They give you direction of price movement, strength of price movement, and support and resistance. You can use these pieces together or separately, but they will also then help you to start seeing breakouts and price patterns. They'll help you see where price is moving into patterns, like the triangle we see here. They'll help you determine whether you have a retracement or a reversal. And this is the critical part of trading in the markets. And next month we have a whole entire class on price patterns. But being able to understand whether the market is just simply retracing or reversing is critical, because retracements are simply the breather that buyers are taking. And what happens is too many traders see this easement and jump out of the markets. And what happens is, yes, they make their profit and they get out of the markets, but they've lost out on the most significant move coming between that retracement and when the market moves back to that uptrend. Okay, so they've just sold. They panicked and sold when they haven't been ready. And what happens, they've missed the entire move of the asset. When you can use short-term and long-term trades to see retracements or determine whether it's a retracement or a reversal, because a reversal would have broken the longer-term trend line, then a reversal tells you to get out of the market or you want to maybe reverse your position, where a retracement is only a breather. And by being able to outlast these retracements, you can then successfully trade. Also, trend lines are used in combination with other indicators. A trend line with a Fibonacci retracement or trend lines with impulse waves can give you great trading systems. They also, like I said, help you see reversals. Now, in our class on trend patterns, we'll look at reversals, trend patterns and price action. We'll look at reversals, breakouts, retracements, continuations. But you have to know how to put your trend line on the charts before you can even see what is a retracement or a reversal. So like here we see we have price in a downtrend and it's moving steadily down. We have the price move back up to that resistance line, which is a downtrend, bounce off it, it broke the trend line. It could have been a possible reversal. This is what we want to look for. In this case, it was a definite reversal and price moved into an uptrend from there. But you need to be able to see this on your trend lines. So we can also see here a reversal point from an uptrend moving to a downtrend. You need to be aware of these, but you don't get these without understanding the basics and putting your trend lines properly on your charts. Okay. And then you can start moving over to support and resistance. And the concept of support and resistance is simple, but there are many, many ways of applying support and resistance to your charts. And I use a triple system. I always use 3 different applications of support and resistance. I use eyeballing, I use pivot points, and I use trend lines. Or I might be using Fibonacci and GAM fans, depending on the trading system. But I'm always using my trend line support and resistance. So imagine it's just like a ball bouncing, and price comes down, contacts it, bounces off, come back and contact it. And it's very important. If you can understand the physics of a ball bouncing, you know exactly how high and how low it's going to go. But you have to start somewhere, and your trend line is your perfect starting point. And like I said, next month we have a whole bunch of new classes on the calendar. The calendar is posted on ETX, so just go to www.etx and look under education. You see the calendar for next month. And we have a whole bunch of classes that will help you move forward with your trend lines and price action, trend action, trend patterns, and Japanese candlesticks. So thank you very much for joining us. Have a good Sunday afternoon and enjoy the summertime. And we'll see you, remember, on Easter week, we're not having any classes. So we don't have the Sunday class on Easter Sunday, and I think we're not having a Monday class, but we have a Tuesday class right after Easter. Thank you very much, and we'll see you again on Tuesday. Have a good week now. Bye now.